Alrighty. So what are we going to do tonight? Slightly different from the last webinar. You'll be pleased to know if you came in for the last webinar that took 2.5 hours. So we're going to do basically the stuff we need to do first of all, which is tell you what we're actually going to be teaching you if you were to decide to join us. And then the second half, so the second half hour, what we're actually going to be doing is looking at today's markets and looking at 3 particular markets where trade opportunities have presented themselves, and we're going to take a look at gold, one particular trade. We're going to take a look at the oil markets, one particular trade, and we're going to take a look at a period of time. In other words, we're going to take a look at a period of about 4 hours. We're not going to take 4 hours to look at it, but we're going to look at a period of 4 hours on the S&P and try and identify opportunities that you might have been able to see. And I'm trying to get you guys to think about whether what you're going to learn is ultimately better than what you're using just now. If it's not, fine, fair enough. If it is, then obviously you can see how we can start developing out a relationship here. Before we start, there's always someone in the room that knows everything there is about the markets, and I've been doing this for 37 years and I'm still learning. Warren Buffett made a terrible mistake with Kraft Heinz and lost billions of dollars, and he's been doing the markets a hell of a lot longer than I have. So 37 years of experience is what I'm bringing to this table. And obviously, as I said, there's always still somebody that is probably here tonight so full of wisdom that they're just going to dismiss everything offhand, straight away, because it makes them look as if they or feel smart, and they obviously already know about this stuff. The big question I've always got for people that are coming along to a webinar in that frame of mind is, why are you even here? If I can't enhance what you already know, if I can't improve your already amazing grasp of market knowledge, because of course you already know everything that I'm going to be covering anyway, if you're here, just don't bother coming in. Go and do something positive. Go do something positive with your time. Do something productive with your time. Go and maybe donate some of your earnings today from your trading to maybe the local animal shelter. Because the frame of mind is so important especially when we do sales webinars. People that make the decision to join us have already got the right frame of mind because they are motivated to do something. Whether you think that they're making a good decision or a bad decision is not your decision to make. It's their decision to make. They want to take ownership of their own future, and they're open-minded. They're willing to sit and listen to see whether it does make any sense. And whether you agree with me or whether you don't agree with me, I don't really give a shit, to be honest. It's up to you to take the information that you're going to be learning tonight, and we're going to do some exercises, as I said, on the S&P at the end of this classroom, that's going to basically try and show you how this thing works. Not everything. It's going to be a very, very simple, basic setup, a very, very simple, basic process. But if I can't show you, if I cannot show you in the last half hour of today's webinar that, number one, it's possible to chuck all your lagging indicators away, all your MACDs, all your stochastics, RSIs, all of them, Bollinger Bands, the lot. If I can't show you that it's possible to chuck all of those away, and that even at a basic level, you can start making consistently the correct decision, and finally, and possibly even for the first time ever, create an edge in the markets, then obviously all I'm going to do is genuinely wish you all the very best in your trading going forward, because obviously I haven't been able to convince you that what we can teach you has any value whatsoever. So if you approach that exercise with an open mind, if you think about whether what you used just now is better than what I'm going to show you, and I'm going to show you the starting point in this exercise. I'm not going to be showing you how deep we actually end up going into it. What I'm going to show you is the starting point. The other thing I'm going to show you in the slides that starts this process tonight is I'm going to show you some actual trade scenarios that we've developed out, that we've narrated, we've timestamped them for you through Twitter. And we've timestamped them for you so that people can't say, well, is this real? Did this even happen? And there's going to be guys in the room that are obviously members of that particular Twitter feed through the class that we do here. And they'll confirm these are all genuine. They're all timestamped. We don't Photoshop anything, guys. They're all straight up. You'll see them for yourself if you decided to join us. But I do feel for people. I do genuinely feel for retail traders who have obviously bombarded with stuff that goes through their letterbox each day, because this is the starting point of all trading, is about taking ownership and about developing out your own narrative of the marketplace. A lot of traders, I've seen a lot of people trying to sell retail traders courses, and it's saying don't have a bias in the markets. How the hell are you supposed to bet on a directional play if you've not got a bias in the markets? I agree with the sentiment. Don't marry that bias. In other words, be willing to change that short term and medium term, perhaps even a macro bias, once you see opportunities to do so, once you see genuine evidence to do so. And that's the subject we're going to be covering in the second half of this webinar. So we'll take about 30 minutes to get through the boring slides. We'll look at some scenarios that we have been doing just in the last few days since the last webinar. We'll take a look at what the trade was suggesting before it happened, and then we'll look at what happened afterwards. And you can start seeing whether, by knowing the information that we're asking you to look at and understand and take ownership of, whether you could have made some money from it. Whether I make some money from it's irrelevant. I could make as much as much as we want. It doesn't make any difference. It's whether you can convert this information into physical cash, and that to me is what's important. So obviously I've got a little starting point here, which is this chap Willink's quote, and it's from a book, Extreme Ownership, from the Navy SEALs. And it's the consistent attribute that made them great was that they took absolute ownership, not just of those things that were responsible, but for everything that impacted their mission. Retail traders have a huge blame culture. They'll blame everything. They'll blame their internet connection, and sometimes your internet connection goes down. They'll blame their feed, they'll blame their broker, they'll blame the last course they took. But at the end of the day, everything that happens to you as a retail trader is because of decisions that you've made, not because of anybody else, but it's because of decisions you've made. And if you take ownership of those decisions, you're already well on your way to starting to become a professional trader, because professional traders cannot lay blame anywhere. Now, I understand that, of course, you can just be pressing a button to get into a trade and your internet goes down. God knows we've had several times ourselves in the room where we've had an internet connection or an internet interruption, and we've ended up losing connection to the room, and that's fair enough. That can happen, and fair enough if you lose money because of that. That's unlucky. But in most cases, take ownership of your trading. Take ownership of the bad decisions and the good decisions you've made in the past, and start moving forward past those. Because you guys' inboxes are full of stuff, and I showed this the last time, and it's just basically one day's emails showing a lot of stuff that people are trying to sell or doing in the internet. Some of the stuff will be good. I'm not questioning it. Some of the stuff will be absolute rank rotten. I'm not questioning it. I'm just saying that you're going to be full of information, and your job is to try and work your way through this. This is why the second half of today's presentation, and we're going to take half an hour for this part, but the second half of this presentation will be asking you to see whether you could make money by making decisions on the right-hand edge. And it's a very simple question, and we'll go through a process where you can make those decisions, and we'll show you what it is when we get into that second half. What did you learn about today? If you're a trader in a room, if you're a trader in a forum, if you're a trader, retail trader, what did you actually learn today? Because let's talk about what we learned today in the room. We learned about credit default swaps and the pricing of those and how it's important to understand that. We learned about volatility in the bond curve today. We learned about a gold live trade explained in detail that went on to make 35 ticks in real time on the right-hand edge of the chart with room interaction. And we asked them, the traders at the time, about the concept of motivation. We asked about whether the directional trade was motivated to be a buy or a sell trade, and who was motivated to do the trade. And we were getting people saying, and subsequent even to that conversation, the trade continued on higher for another couple of $100, and the guys were live in the room watching this in real time. So is it possible in the right-hand edge? Absolutely. We covered an S&P real-time trade as well, where we made 20 ticks live in the room. It doesn't sound like much, guys, but these are just examples of things that we talked about today. Today we talked about rolling down the yield curve. We talked about contango and backwardation. We talked about the motivation behind directional trades linked into that gold trade. We talked about the bond break-evens. We talked about Brexit. Well, there's no day that passes that we don't talk about Brexit. we talked about the Fibonacci fallacy. And the Fibonacci fallacy is a really interesting concept, because a lot of people use Fibonacci, and I've really never quite grasped why, because it seems to have become, a retail trader's world of pain, basically, because most people don't really know what they're supposed to use it for, because it was never intended, of course, for anything to do with the marketplace. It's some natural phenomenon which does exist, by the way, but it's a fallacy in terms of the financial markets, and I'll explain why that's the case. We did a study, and it's not just ourselves. There have been several bank studies that have been taking place. But in our study, we did a study of 191,000 observations on pullbacks over different time frames, ranging from 1-minute charts through to daily charts. 191,000 observations. The period of this, by the way, was an exercise that we carried out in backtesting from about 2005 to 2015. It was about 10 years worth of observations on different charts, different markets, including Forex, futures, and individual stock equities and index stocks. 191,000 observations, and there was a very, very simple setup of rules, and we used the same rules as other independent studies had used, and that is that we did a trade that could not break the previous swing, but then obviously takes out the other top edge of a swing, for example, by at least 20%. Some studies do 25%, some did 50%. But obviously all we've done is a very, very simple study to see what percentage of those situations resulted in pullbacks. Now, if Fibonacci is correct, the 38.2 and the 61.8 pullbacks should have a significant number of observations associated with those pullbacks, because obviously, therefore, they are meaningful in the marketplace. And I hate to burst the bubble of anybody that likes Fibonacci, because it doesn't work. But anyway, this is what actually this looks like. The chart in terms of the percentages on these things actually looks something like this. And I'm just doing it roughly, guys. I'm just doing it roughly. This is what that chart looks like in terms of the number of occurrences where the price pulls back to just before 100%, because obviously if it goes through 100%, it doesn't count in terms of the pullback, of course. And one of the things you'll be able to recognize is that if there was any truth in Fibonacci, this would have a higher than expected response against this, and it doesn't. And if there was any truth in Fibonacci, this would have a higher expected response, and it doesn't. The highest expected response actually works somewhere in this area here, and it's between 50% and 75%. That's where the highest observation was made from 191,000 observations. So please do me one favor and toss your Fibonacci in the bin. It's got no relevance in the world of institutional trading. People will talk about it just for a reference point because people do know about it, but it doesn't have any reference, that it doesn't actually have any reason to exist. It doesn't have any actual usage in the marketplace in the side of the world of a bank. So take your own observations if you like, go away and do your own studies, but that's what you'll find is the same type of results, because we've looked at studies from 2000 to 2015, 2000 to 2010, 2016 to 2018, and they all result in several, the same similar type responses. So the Fibonacci fallacy. Let's take a look at some trades that we've seen in the last couple of days, and you can see whether you could have made some money on these. And we'll start with the timed tweet first of all. And the first chart you'll see here is a chart of oil. And you'll see that this is from the 26th of March, surprisingly enough, 26th of March. So today's market, if you're in the US, today's market. The times that you see on the charts are London time. And one of the things you'll be able to see here is, so this was at 1 o'clock in the morning. So in other words, about 24 hours ago, basically. So this tweet was from about 24 hours ago, 1 o'clock in the morning. Oil, where we go from here. Expect profit-taking selling at the $59.50 area. We'll wait for value to rebuild. So what are we doing? Well, if we expect profit-taking selling to take place at $59.50, guess what happened? Well, if you look at the bottom here, you'll see that I've got a circle, and it doesn't circle anything, but I'm trying to just highlight the point that this circle is approximately around about as you can see here, around about 8:20 in the morning. In other words, just after the London oil markets opened. 8:20 in the morning. In other words, approximately 7 hours after this tweet went out. 7 hours after the tweet. The second thing you'll notice is that we're going to be looking for selling. And the third thing you'll notice is that we're trading at a price of $59.50. So you'll obviously be able to look at this chart and you'll see that there's the $59.50 at the top edge of the chart. You'll see that the price traded almost exactly to $59.50, where we said that there was going to be profit-taking selling at $59.50, and then proceeded to sell off instantly from $59.50 to $59.30, a profit of $200 per contract from a tweet that happened 7 hours before the price even took place. You might think that's not very impressive. You might be thinking, yeah, well, fair enough, great, good stuff, and what? So what? Well, is it not useful to perhaps know where these levels are? Is it not useful to consider and understand why there might be profit taking at that price, so that you don't have to rely on me telling you that that's going to happen? You already know it's going to happen there, so that you can step into that regardless of whether I send a damn tweet out or not. The answer should be yes, it would be useful to know that information, because I would like to make that $200 per contract as well. Take a look at natural gas, and you can see here there's a tweet. It's timed at 10 past 10 in the morning for today, 10 past 10 in the morning, and this chart is attached to the tweet. And you might be saying, okay, well, you know, what is the point of this one? Well, you'll see that at 10 past 10 in the morning, I've put some 2 pink levels that are reference points for these trades. Trade number one, we are already telling everybody that the only trade we're taking on natural gas just now is a sell trade. The guys know that in the room. So we've got 2 key levels. This level here, which is trade number one, and you can see that we have already highlighted it at 10 past 10 in the morning. And trade number two, which is at this level here, we've highlighted that at 10 past 10 in the morning. This is what subsequently happened off of trade level number one. And this is what happened off of trade level number two. The price traded up to trade level number two at 11 o'clock in the morning, about an hour later after the tweet, and the price proceeded to sell off for $200. The price then rejected this bottom edge here. We took some profits. The price then rallied all the way through the top edge here of price level number two, and guess where it stopped? Price level number one, a level that you already know about on your charts from 10 o'clock, and it did that at approximately maybe 12 noon. So in other words, about 2 hours after the original tweet was already in your hands and the lines were already on your charts, this level was then traded, giving you a great opportunity to sell some gas at this price for a profit of $400 into the close in the session. Add 2 trades together there, guys, and you've got $600 profit off of a tweet that took place 2 hours and 4 hours before the trade actually even took place. Add that to the oil trade from this morning for $200, and all of a sudden you're sitting on $800 on a single contract, one on the natural gas and one on oil, which isn't too bad. Let's take a look at something else that we talked about recently in terms of a trade. Let's take a look at this tweet from from earlier on in the week. 22nd of March. So we're going back a little bit here, guys, but this was such an important tweet. Midnight, 12:55 a.m. in the morning, in fact, 22nd of March. Well, you can see down here that this is now the 8 o'clock in the morning. So this is about 7 hours after this tweet has taken place, okay? So the chart on the right-hand side is 7 hours after the original tweet. And what I want you to look at here is the care warning. And for the guys that understand this care warning in the room, everybody knows what we're talking about here. And hopefully, if you decided to join us, you would know what this care was all about. Well, what do you think care is? It's a warning, isn't it? And we did it in capital letters so that people could even see it. Care. Belly top bracket just above. We drew a line on the charts, and look at what happened to the S&P 7 hours, 8 hours after the warning was made about the S&P. 7 or 8 hours later, the price then collapsed into a puddle for $750 per contract profit. Now you might be saying, yeah, what does it mean? I mean, a care warning doesn't tell you that it's a sell trade. Well, come on, guys, seriously. I'm not going to make a care warning and it's going to rise, am I? The guys in the room know what this care warning was all about because we specifically described it in the room to everybody. What I'm trying to get across here is this really something that you could use? If you knew that this was going to be getting sold, could you draw a straight line on the charts and press a sell button and make $750 per contract from that information? If you couldn't, I'm surprised. I'd be genuinely gobsmacked if you couldn't make $750 from that trade. Perhaps it's outside of your time zone. That's okay. Some trades are, some trades aren't, and sometimes that's the way it works. Anyway, let's kick on. So you can see $750 from that trade. Now you might be saying, okay, well, I don't trade the S&P, I don't trade oil, I don't trade any of these markets, gas or anything like that. I trade Forex markets. Okay, so here's a tweet about Forex. And this tweet was at 2:47 a.m. on the 20th of March. And obviously that puts us, you'll see at the very bottom of the chart, there's the 20th of March. The arrow is approximately at 2:47. Perhaps I've got it a little bit early. Perhaps it's a little bit later, maybe towards the middle of this little box here. Doesn't really make much of a difference, does it? But take a look at the content of what we said here. This is cable. If you don't know cable, it's the pound against the US dollar. So cable, don't know who's buying, it's not me. I'm a seller still, and we'd been selling this from the room, from this top edge, but we hadn't had any progress to the downside when we sent out this tweet. So I was curious to know who was buying. It's not me. I am a seller still of that higher previous day high. Surprised it hasn't broken yet. Chatter of significant delays in Brexit, okay? So we were starting to get some sound bites, we were starting to get stuff, but I was really surprised at this point, at 2:47 in the morning, I was really surprised it hadn't broken. Well, within 12 hours or 10 hours later, the price did exactly what we thought it was going to do and then collapsed for 150 pips profit to the downside from the original sell, or for 100 pips from the retest of this wholesale price level at 32 and a half. And you can see that the sell-off that we were expecting and that we tweeted about, that we highlighted, was then completed, and we were able to execute the exit on that trade for a profit of, as I said, either between 100 pips or 150 pips, depending upon where your entry was on that trade. Could you have made money from a tweet that said that I'm still selling? I'm just surprised it hasn't yet broken. In other words, there's still an opportunity for you as a trader to step into that trade and take advantage of it. If you were in the room, you would have already known about the short trade, and you may already have been in the trade with me. But we're telling you a dialogue here, guys. How many times would you have the confidence to see a balance area developing like this and look at it and saying, if only I got a trend line break to the upside, that would be really bullish? Well, it wouldn't ever be really bullish. All we were doing was waiting for the market to do what we expected, and that is sell off. By knowing which direction the market's going to go in, is that not beneficial? You might say impossible. You might say it's impossible to know which direction the market's going to go in. That's why the second half of this presentation, we're going to look at the right-hand edge of a developing chart to see whether you can see on the right-hand edge what's going to develop. We're going to be asking you to do the trades in your own way, how you would get into a trade if we gave you a very, very simple set of rules. And that's what we're hoping to try and be able to prove by doing this exercise, that you're able to see that there is a possible way forward for your trading. So what else have we had here? We're a wee bit behind here. So a couple of trades that we have actually traded recently. We had the 18th of March was the most recent volatility trade that we had in terms of our stock. We had a long volatility trade. You can see here. Here's the timestamp at 7:46 p.m. on 18th of March. Long volatility MIK play today. At the moment, the trade cost is $1.90. So far, we've taken $1.70, $1.20, and $1.50 on Gamma Scalps. And therefore, we have made $250 profit per straddle, or 131% on invested funds. So if you invested 25% of your account in this particular straddle, then obviously you've made over 25% return on your account, because we've done 130% on that particular volatility trade. We have had a couple of repos, not that many. We've had a couple of repos. TWI, after the bell, announced a small repo. The first opening trade, we got a little pop higher, 10 cents, and then it dropped back down, gave us a scratch trade. It came down to a previous swing, previous swing level. We got some more buys. This is today's market, by the way, 26th of March at 9:58 p.m. hours before the US cash open. So you would have got exactly the same two trades as these. If you do the classroom, you'll learn where these trades exist and how to get these trades. And obviously what happened was we got a second buying opportunity down here, and then we closed at the close, and we made 3.6% on capital invested, 3.6%. So if you'd invested half of your capital in that one, you'd obviously have done around about 1.8% return on your whole account on that one single trade. The other one we've had recently from the 20th of March was RDN repo. This is the only reason that this has been repeated several times is because we've been consistently getting slightly lower prices on these trades based on some value divergences. We've been able to take advantage of this repeatedly over a period because we haven't had that many other stocks actually coming up on our radar on our screens. So obviously in this type of situation, we bought once, we took a scratch on that trade, we bought a second time, nice profit, bought a third time, nice profit, bought a fourth time, nice profit, bought a fifth time, nice profit, 10.26% so far on RDN, and we're probably just not going to be bothering looking at this one again because we're obviously going to be hoping to get some new fresh information from some other companies coming out in the next few days. So is it possible on the right-hand edge to make money in equities? 10.26, 3.6, and 130% on capital employed on a live tweeted time-stamped trade. Could you have made the same money? Absolutely, to the cent you could have made the same money. So it is possible to do those particular returns. Let's take a look at an oil trade here from the 21st of March. Oil supply showing up on WTI. So if we pick up any expensive oil, look at the price level. Look at the price level. Now take a look at the time. 1:27 a.m. London, 21st of March. Take a look at where this box is printing, where that little dashed line is. 2 o'clock in the morning, 21st of March. In other words, about half an hour after the tweet. So this box is half an hour, this dashed line is half an hour after the original tweet. We've given you a trade. Oil looks expensive at $60.25 or above. At the moment, we will be looking to go short-sided play. Any ambiguity, guys? Is there any ambiguity? Is there anybody that doesn't know what that scenario is? You should be selling, guess what, at $60.25 or above, and you know that before it even happened. The price then traded $60.25, sold off to $58.70. That itself is a $550 profit. It then traded $60.25 a second time and then proceeded to sell off for a maximum of $2,000 per contract over the next 24 hours. Did we know about it in advance? Yes. Can we prove we knew about it in advance? Yes. You can see the tweet. It's time-stamped. If you come into the room, you'll obviously be able to see that all of these tweets are still there. They haven't been photoshopped. And the guys that are regular in the room will be able to confirm with 100% accuracy that we do not delete tweets. We don't delete the bad tweets. We keep them there. Whether they're good, bad, indifferent, we keep them there and we highlight what the tweet means. Whether they're good, bad, indifferent, we keep them there and we highlight what the tweet means, why we've taken that scenario, and we're trying to get you guys to understand why that trade exists and marry that trade against your own analysis so that you're not relying on the tweet, you're not relying on my analysis, but you're using my analysis to uncover the trade opportunity that you can take ownership of yourself. You can see that this is quite clearly hours in advance, not hindsight, and it drops for $2,000. Who else is giving you that quality of information off that top edge on oil? Who else is telling you with that accuracy of $60.25, 8 hours before it happens, that you should be developing a short-sided trade off of that price print, which then drops for a $2,000 verifiable profit to the downside? Beautiful. So when we start looking at some of these ideas going forward, we can obviously look at things like why traders do fail. They don't know whether they want to trade like commercials. They don't know whether they want to trade from an algorithm or an indicator. They don't know whether they want to trade like a market maker. They think there's obviously some sort of mean reversion type trades that they can do and all these kind of things, pattern trading, and they're just sold so much stuff. And some of it's useful, but you don't know how to put together the jigsaw puzzle because you're missing certain pieces. And you don't know which order the pieces should go in. So you know there's got to be something in market profile. You just don't know quite what it is. Well, guess what? This is where we tie it all together, guys. For the first time perhaps ever, we tie all of this stuff together. So what is it? It's all of these things. It's technicals, it's fundamentals, it's volume, it's candlestick analysis, it's volume spreads, it's market profile, it's deltas. It's all about option selling or buying straddles. It's all about stock picks. It's about the dark pool activity. It's about market internals. It's about spread trading. It's about order flow and footprints. It's also about swing trading and position trading and scalping. It's about all of these things. And the problem that you've got with all these other courses is that they are so focused on one thing and one thing only that they don't give you the full puzzle. They make you come back for more. They make you come back for more because you know that the puzzle isn't complete. There's got to be more to this. I've just seen a huge volume candle. Is that a sell or a buy? Well, if it's at the top edge, it's more likely to be a sell. Why? It might be a big buyer at a higher price, and that's the only price they can get filled at. Well, good point. So is it a sell or a buy? I don't really know anymore. Let's find out. Trade like a commercial. Well, we all know that commercials, if you look at it from the CFTC's point of view, are engaged in hedging business. In other words, they will be getting long as the price drops, and they'll be getting heavy short as the price rallies. So do you really want to trade like a commercial? That's the big question. When you look at a CFTC report or a chart of the CFTC, you'll be able to see exactly what we're talking about. Commercials in the green line are rising as the price is dropping. So in other words, they're getting longer and longer and longer as the price drops. If you try and trade like a commercial, guys, in terms of a directional bet, you will lose your money very, very, very quickly. Very quickly indeed. Do you want to trade as a mean reverting spread trader? Well, sometimes it's a useful idea to start some processes with, but in general terms, the answer is no. You don't want to be trading some of these algorithms either, which indicators do letting indicators do the hard work for you is usually a road to ruin. Why? Because you're passing off your ownership onto some sort of black box that you don't really understand. You don't know why it makes trading decisions, and therefore you've got no way of knowing what to do about it if it starts going wrong. Forex Factory is full of these types of indicators. Forex Factory and all of these other various indicator shops sell loads and loads and loads of indicators to hundreds of thousands of retail traders, and most of them end up in the bin. Let's be honest, how many of you bought recently that have ended up pretty much as much use as a chocolate ashtray or an inflatable dartboard? Probably most of them. Some of them might give you something that you can use. Most of them end up in the bin and you've wasted your money. When you're using the likes of your MT4 platforms, your TradingView platforms, or Sierra Charts, or NinjaTrade, or whatever it is you're using, most retail traders spend the majority of their time changing parameters on indicators. And that's a real pity because they think it's a good effort, they think it's an effort that's worthwhile doing, but it's not. It's simply not. And one of the things we talked about earlier on in the week here was we were talking about the guy that has these force-fitted results. And they look at the force-fitted results, and it's a straight line graph that points north. They see all these brilliant win after win after win after win after win, 100% winners. And they think, that's the setting I need to use. That's the setting I need to use. And if anybody knows anything about probabilities, you'll probably realize that what that winning sequence is actually all about. If there's anybody in the room that's done statistics before, you will confirm with me, of course, that what is happening with these types of situations is this. If you start with this here and there's a toss of a coin, then obviously what's going to happen on a 50-50 basis is that you're going to get one winner and one loser. Now let's assume that you start out with 1,000 parameters on whether you toss the coin as a plus or a minus, okay, a heads or a tails. You start out with 1,000. And obviously if you start out with 1,000, then obviously if we go ahead and we take the winners forward and we discount the losers, because obviously the losers have the same decision to make the next time, but we'll just do the winners for the time being. At this point, there's now 500 that were correct in their assumption that this was perhaps a heads. There's now 500. Now, what happens next? Well, we do another toss of a coin, and what happens, of course, is that there's a half of them on average are going to win and half of them are going to lose. So what's going to happen is you're going to end up with this number here, and there's all of a sudden everybody's looking at this saying, okay, yep, we've now got 2 correct decisions in a row. There's 250 people that can now boast this 100% record. 250 people think they've got the Midas touch in terms of the toss of a coin. Here's the next one, and you can see obviously what happens next. Very, very simple. We get another series of winners at the top edge here, don't we? And all of a sudden we've went from 250 people that are still in the game to about 125. They've now got 3 in a row right, guys. There's still 125 of these things happening. And then we do it again. 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 And guess what happens ultimately is we start getting less and less and less. We went from 125 to, for argument's sake, 60, down to 30, down to 15, down to 7, and then finally maybe down to 3, okay? And all of a sudden you're thinking to yourself, okay, well, what relevance is this, Ray? I don't understand what the point is and what you're trying to prove here. The relevance is, this is what happens when you force fit an indicator into your setups. You start off with 1,000 parameters, 1,000 different parameters, and you start doing a force fit, and you say, well, find me trades that don't lose money. And it starts working through this process of trade setups that don't lose money. So there's 1,000 that start out, and all of a sudden there's 50 that don't lose money, 250 that don't lose money, 125 that don't lose money. Eventually there's 3 that don't lose money after this number of occasions. Now, does that mean that those 3 have an edge? Or is it just probability that you would always get something at the end of that process that suggests, of course, that if you were to put your money, all of your hard-earned money on the right-hand edge, it's won every single bet up to now, guys. You've got a 50-50 chance of it being right the next trade, haven't you? Because out of those 3, one of them's going to win, one of them's going to lose, and the coin will end up standing on its side for the third one, of course. So you're going to get 1 winner out of those 3 trades, or 2 winners out of those 3 trades, probability-wise. Therefore, what was the point of getting this process? What was the point of doing this process to end up with a 50-50 chance? The answer is, there was no point at all. It was force-fitted. And this is the problem with indicators. This is the problem when a lot of people think that they're trading, when they go through this process of just going, find me the indicator, find me the setting on this indicator that doesn't lose. Well, all you've done is you've taken away all of these losing trades here, not because they're bad trades, it's just because they had a 50-50 chance and they happened to, on this one occasion, to lose. This guy at the top edge knows nothing more than the guy that lost the first bet. The guy at the top edge knows nothing more than the guy that lost the first bet. In other words, the algorithm, the setting, at this top edge setting, is worth as much as this bottom setting. Something to ponder, because a lot of people don't think of their indicators like that. They see these box tested and force fitted results, and they think how amazing those results look. And yet, how many times do you go ahead and buy into that storyline just to find that as soon as you put it on the charts, it doesn't make you any money? Well, guess what? That's because it is force fitted. That's because it's purely found the setups, and everybody can do it. If I look at today's horse racing, I could find you a setup that is absolutely guaranteed to win money today based on today's results. If I use it tomorrow, my chances of making money with it are pretty close to 0. I might get lucky, I might not. So in other words, it's just pure luck. So I hope that makes some sort of sense, guys. I hope it resonates with people, because it's very, very simple to think about that process. Very simple. So analyzing settings on an indicator is not about whether you should be changing it from a 5 period to a 15 period, back to a 9 period, up to a 25 period, up to a 50 period, filtered with a 25 period. All you're doing is force fitting prior results. And it's not going to take you anywhere, and it's going to waste a lot of time. It's going to make you hellishly frustrated with your trading. And really, there's better things to be doing with your trading time, guys. So obviously, we've got to try and get past that. We've got to try and get past these types of hurdles that you guys are facing every single day. Do you want to trade like the market maker? Probably not. Market maker is usually on the other side of the book from the commercials. So therefore, the market maker is on the wrong side of trends, for example. So you don't really want to trade like the market maker. But is it useful to know what the market maker model is like? The answer is absolutely yes. In this classroom, in the full classroom, and in the mini classroom, we're going to talk about the market maker's model. And we're going to talk about how we can use these simple levels that develop on a chart to go after the market maker's model itself, and how the market maker will react under certain stimulations. And we obviously take a look at a thing called toxic order flow so that we can understand how that can impact in the market maker and what the market maker does about that. The chart on the left is the result of some toxic order flow. The green line dropping hard, for example, the speed tick increase at the very, very top, we call it voltic. It's called velocity on the tick. If the speed on the tick itself increases really, really rapidly, that gives us some sort of signal that tells us there's some commercial activity. And obviously, if it then corresponds to the market maker taking liquidity away from the price, and it corresponds to some order flow that's heading into this is not a lagging indicator, it's a real-time indicator. Well, then obviously what happens is that the price then drops. Useful in the right circumstances. So do you really want to trade like the algos or the commercials or the HFTs or the market makers? The answer is sometimes you want to trade like the commercials, sometimes you want to trade like the market makers, sometimes you want to trade like the algos, you want to trade like the HFTs, and we show you how and when those types of trades actually take place. A lot of people, when they look at the markets, they think they see patterns, and this is another problem for retail traders. Their brain is structured in such a way that they are basically taught to see patterns in the marketplace. You see patterns in everything. You see patterns in your partner's behavior that tells you, oh my God, they're in a mood. And you simply just avoid them, or you simply, you start getting involved in an argument when you know fine well that they're in a mood for some reason. You can see patterns in everything, but sometimes you make a mistake in those patterns. You see patterns because you want to see patterns rather than because they are real. And that's why we're going to be doing an exercise at the end, because I want to see whether you guys can see what the trade is. If you can justify yourself to take a trade off of something that you're going to learn tonight from simply looking at a simple concept of divergence, then you're going to be able to look at it and say, I actually do see that pattern that makes some sort of sense. And that's what we're going to be talking about later on. What we teach in this room is why. Why is price moving? Not because of rising or falling wedges, or because it's got a broken moving average or a neckline or a pattern. Not because it's a completed wave C of an ABC correction. Price moves because there's a reason for commercials to be involved in that price. There's a reason for the commercials to step forward. We want to give you the reason why commercials buy a market or why commercials sell the market. And we're going to start that process tonight in the second half of this exercise. We're going to start looking at some trades and ask you to try and make an identification of what the commercials are going to be doing. And based on that information, not hindsight information, but based on what the commercials should be doing, you can make trade decisions. And we're not going to go back for weeks and weeks and weeks to find perfect setups. We're going to be looking at markets that traded today, the oil market, the gold market, and the S&P market. So we're going to look at those trade setups and think about what you would have done on the right-hand edge, presented with the same information, the same stimulus coming from the commercial setups, okay? So we've got to be able to define that. We've got to be able to look at something and be clear about what we see. And if we're not clear about what we see, guess what we do? Nothing. We pass on the trade. We wait for something better to start coming along. Here's an example of what we're talking about. Take a look at the first sell arrow. It's a breakout of the top side. You can see the pink line drawn across the top of your chart there. There is actually a breakout there. Why is it not a buy trade? If you trade breakouts, for example, why is that not a buy trade? Price breaks hard and fast at the top edges. It looks like it should be a buy trade. Why have we got a sell arrow on that break? It's not because I can see what happens next, of course, but why is there a sell arrow up there? Why is there a sell arrow? Well, let's take a look at what commercials were doing on the price break to the top side. This is what commercials were doing, which is the green line. you can see quite clearly that the commercials were actually heavily selling as the price broke to the top side. So if you know that commercials are selling, what is the break to the top side? It's an attempt to get some sort of liquidity, because perhaps it's happened during the quiet liquidity period of the day, which it is. If you look at the bottom of your volume chart down here, you will see that this price takeout at the top edge happens before the big volume of the day steps into this market, which happens to be oil. So this takeout of the top edge is trying to generate liquidity and volume, because institutions need volume. They are not sensitive to price. They are very sensitive to volume. There is absolutely no point in me getting a top tick if there's 2 lots on it. There's no point in Goldman's getting a top tick price if there's a 5 lot sitting waiting for that trade to take place. 5 lots. They may have 50,000 lots. They may have 10,000 lots, 5,000 lots to get on. A 5 lot at the top edge is not of any particular importance to them. But if we can game some stops and see what kind of volume is up there, we will do that, because obviously if it generates some stop liquidity for us or some hedgers step in, we can use that information to find some great trades. Now, obviously, what I'm hoping you can see is a top edge, an ability to draw a straight line across on your charts, identify a top edge. Well, guess what, guys? This would have been a legitimate, genuine trade opportunity for you should you have joined the room. It resulted in a sell trade that made $1,000 per contract before it finished over the course of 3 days. Yeah, 3 days. You could still have made 500 on each of your day trades, so you could still have made $1,000 even if you didn't want to sell for the single swing. Do you not think you need to know what that is all about? Do you not think you need to know what the commercials are doing so that you can step into these types of trades off the top edge? Well, I would assume most people, if they're being sensible, would say that you really do want to know what's happening here. Of course, you can choose your own hours if you're a retail trader. However, if you want to catch the big trades, we have obviously teach you where to be positioned, when to be positioned in the markets. And if you're going to take advantage of that type of information, then obviously what you can find yourself doing is you can find yourself focused more on the big moves. You can actually get involved in some of the big moves because you're at your desks and you're working when the big moves start developing. It's not about choosing your own times, because you can, whilst you can choose your own times, it's important to understand that the big moves generate from volume always. They don't generate from top edge rejections on a 5 lot. They generate from volume. And therefore, you know that there's certain volume times of the day that are very, very important to the markets. So it's very important that you pay attention to those, and we'll obviously teach you what those are all about and how to take best advantage of those volume areas. Do this course and you'll become an amazing trader. Unfortunately, that is not the case. There's going to be traders that do this course that simply can't apply the information that we teach, and that's just down to those individuals. It's down to my inability to connect with them. And obviously that's just unfortunate. It's reality, however, guys. It's just one of those things. We're not going to tell you that you're going to, every single person is going to come away from this course and say, you know what, I am definitely going to be a professional trader, get a job at Goldman's, and everything will be do-dandy. So it's the same as anything, guys. If you do the same course as somebody else, you're going to get different results. Not all of you are going to be A+ students. Some of you will be C+ students. Some of you won't even pass the course. Some of you will be D's and E's. If you do a golf class with Tiger Woods, some of you will get close to improving to a scratch potentially if you put enough effort in. Some of you will be able to improve your handicap by a couple of strokes. It depends how you apply the information, and I can't make you apply it. I can't force you to understand this, and I cannot make you agree with me. All I can do is present the evidence and see if you're resonating with you and if you buy into the storyline and the narrative. And through the experiences that we show every single day of the week, it shouldn't be too difficult for people to buy into the narrative. It still requires you to implement that narrative, develop your own narrative, take ownership of that narrative, and then you've got a lifetime of trading ahead of you without having to hold on to me or anybody else. You can do it for yourself. So what are we going to cover very quickly? Week 1, we're going to be covering equities and order flow. We're going to get you up to speed on those types of things. We're going to look at market maker pricing of equities. We're going to look at stock trading. We're going to look at event horizons, short-term volatilities, long volatilities, commercial interest, gamma scalping, and obviously we're going to give you those signals that we're talking about in terms of the Smart Alpha. If you want them, then obviously you can do that. Inside the world of order flow, we're going to show you the useful tools that are actually there. We're going to look at the market maker's order flow model. We're going to look at the interns exercise, learning how to do the basics of L1 and L2 liquidity, talking about market maker toxicity, how to build a simple but effective directional model for your short-term order flow. And the reason why we do that is because we want to show you that even some simple models can have some incredible benefits for your trading. If you develop the model out, as you have got the ability to now develop these models properly, once you do this class, you can actually start adding elements yourself into these models. And there's many traders that go away and do this. We had one particular oil trader that runs over $100 million trade account, and he trades specifically in oil because that's his core business. And he's taken a lot of the classroom stuff that we've used, and we've taught him, and he's gone and built his own models around that type of trading. So how to build simple but effective directional models, how to use things like exhaustion and absorption for volume analysis, price action profiling, and obviously the liquidity order book. We're looking at large orders before she goes squeezes, footprint charts, market deltas, and looking at the process of identifying a whale in the marketplace. The trades that we talk about in terms of equities are stock buybacks. Stock buybacks obviously can increase shareholder value. We give out quite a lot of these. They're not every single day. We've only had one since the last webinar, and obviously we've shown you those, and obviously it's made a profit. Well, we've had one since the last webinar, and then we've repeated one because it's at a lower price, and we've made 10% on it. If we look at the run up to the last webinar, you can see that we've had quite a few. We've had quite a few trades, but you can see that there's not that many. We've had no more than 2 in any one day. But you can see that if you started with a $20,000 account, that trade would now be worth $37,258. Not too bad. Not too bad. And they're all tweeted. They're all time-stamped. You can see them for yourself. They are not photoshopped. They are not cherry-picked examples. This is every single one of them. If we look at the long volatility trades, these are the other trades that we teach in terms of week one. We're going to talk about long volatility. We're going to talk about gamma scalping. We're going to talk about synthetic stock positions. If you can't sell into a stock position, we'll talk about synthetic shorts. Then obviously we're going to be talking about long volatility trades. All trades are based on specific event horizons or special situations originating from some dark pool activity. So we're going to be looking at those kind of things through to option activity, and then we'll obviously be looking at them, especially in relation to things like earnings. In other words, some sort of event horizon coming up. These trades have been incredibly successful depending upon how much money you want to invest in them, depending upon what percentage of your account you want, depending upon how much money you want to invest in them, depending upon what percentage of your account you want to put into these. But these trades alone, this is the net profit on the right-hand side. These trades alone are just for the last expiry on March the 15th. So we've had a lot more than this as we went through the start of the year, a lot more. So you'd have been able to make yourself a lot of money off of these trades had you obviously implemented the trade beautifully. Take a look at this next trade and see how amazing this trade was. You'll see that there's a timed tweet. It's from 3:45 p.m. on the 21st of February. This was for a stock called Roku. Earnings volatility, short-term straddle, bearish skew. So we obviously could see what the market maker was doing. They had a bearish skew in the trade. We don't overpay, so we basically buy a straddle. So we buy the calls and the puts at the money, calls and puts. And obviously what happens is we end up with this volatility cone, effectively, which just simply means you've got to get above that pink line or below that pink line to be profitable on one single move. Now, obviously, we don't have to always get outside of this area because we can gamma scalp it and still make profits. But you can see what happened after the tweet. The price exploded off of the strike price at $52, and it ended up a high print price of $74 before coming to expiry. Now, obviously, gamma scalping that was a bit of fun because every time you gamma scalp when you're above the pink box, it's just pure profit. And we don't leg into gamma scalps, guys. If you own a straddle, for example, if you own a straddle off the $52 and you own one straddle, when the price hits into these top edges, we sell 100 shares. That's it. We don't leg in, we don't leg out, we don't take 30 here and 25 there and 50 there or whatever. We sell 100 shares. So as soon as we sell 100 shares, we are now 100% fully hedged on that trade. We take that trade to expiry, wherever it finishes, that's now the locked-in profit and trade. okay? So it's a very simple process. You don't have to think about gamma scalping. I've got to start learning all the Greeks. I've got to no, you don't need to learn any of that stuff to be properly suited and booted to make some nice money in the equity markets. So that's what we're going to learn in the first week of the course as well. If you want to. You don't have to, guys. You don't have to learn this type of stuff. But if you want to learn it, it's going to be there anyway for you. This is going to be a small monthly fee that's in addition to the classroom. If you want those particular live trade scenarios, it's $50 a month, and that's obviously cancelable at any time. If you decided you want those scenarios, you don't have to take them, guys. We really don't. You don't need them. But obviously, it's going to be there if you want to take them. We'll obviously be covering first week a lot of order flow. We're going to be talking about quality spreads. We're going to be dealing with some important market internals. We're going to be covering things like the prem, the difference between the actual underlying cash market and the futures markets, which is called the prem in the indexes. It's also called the basis trade in things like the oil markets and things like the bond markets as well. If you progress onto the full course, then obviously we're going to expand those principles significantly when we start looking at the markets like the dollar index, the forex markets, the bond curve, the CDS risk line, and so on and so forth. So let's look at the full-time course, not the full-time course, but the full course. The course is why. Basically that's what we want to get to from the full course. Trade and earn in the equity plays, and obviously learn as you go through this. We're going to touch on fundamentals. Why are they important? The pre and post data trade setups, contango backwardation, technicals, market structure, bank targets, key wholesale price levels, accumulation and distribution, market profile, why it's important, what's important about it, what makes the markets move, whether it's forex markets, whether it's the oil markets, whether it's the bond markets, whether it's agriculturals or commodities. We're going to look at all of these markets every single day. It's an open room, guys. When we're live, when the guys are in the room there, they are in the room. We talk about stuff. We crack jokes. We're in a community where the people can ask questions. Whether I see the question and answer it, they can always repeat it. So obviously a lot of people can find out what it is they need to know. They can try and get a little bit of help on what they're finding themselves when they're looking at the trades. And there's always guys in the room that are also willing to help as well. So you're not going to be left alone. It's a great little community, and obviously it's up to you how you use it. So what are we going to start with? We're finished the kind of slides. What we're going to start with, guys, is we're going to start very, very quickly. We're a little bit behind. I said that this would take the first half hour. It's taken an hour, so we're a little bit behind, but we'll finish off in the next half hour. I want to look at a couple of very, very simple things. Number one, wholesale price levels. Why are wholesale price levels important? And a lot of people think about this and they don't really know, but why should you put round numbers on your charts? Well, there's a very, very simple reason why round numbers should be placed on your charts, and that's because there's a lot of business at round numbers. Institutions don't generally go in to buy a market, for example, on the pound at a price of 12. They'll try and deal at zeros, and they'll try and deal at 50s. And this is one of the reasons why they'll do that, because there's a lot of strike volume on different markets at round numbers. You can see here, it's not $53.18. It's not $55.12. It's not $60.75. They're all round numbers. So guess what happens when you head into round numbers? Volume. Somebody's in the wrong side of that trade on whichever side of 50 this price goes. Either the guy that sold this level or the guy that bought this level is going to make a different response as the price goes backwards and forwards around the 50. The 50 may also be a level that has a lot of support. It may be a level that has a lot of resistance. It may be a level that has a massive sell-through because of hedgers. But one of the things that we are very, very tuned into is that the institutions will always deal at these levels. Why? Because there's always volume. And that's it. So one of the things that we need to always look for when we look at a chart is we need to look at areas where volume exists. Now, you don't have to look at volume to know where volume exists, guys. If I draw the round numbers on a chart, for example, here and here, I don't have to look at the volume at the bottom of my chart to know that there's going to be volume existing at these prices. It's pretty much a given. It's pretty much a given, isn't it? So obviously there are other areas where volume exists. So price comes up to here. We know there's going to be volume at that price. We know the price might come off that level and do this. And the price might break down. We know that there's probably going to be volume in here, don't we? Why? because obviously you've just taken out a bottom edge. There's going to be some liquidity there, and obviously whatever they do with that volume, we can obviously figure out. We know there's going to be volume there. We know the price is probably going to have some great volume here because it's not only taken out some previous lows, it's also taken out that liquidity. So there's probably going to be a big spike in volume in this area. And we want to know about that. Why? Because volume equals commercial activity. Commercial equals something that you want to know about and analyze. It doesn't have to be at the bottom edges. Sometimes volume appears somewhere in the middle of a chart at a level that you just don't expect. Your job as an analyst before you start trading is to start understanding, well, what the hell is that telling me? What am I supposed to do with that commercial interest? Do I buy it? Do I sell it? What am I supposed to do? So it's very important that we understand this. Now, what I also need you to understand as this little exercise progresses is the process of what we would call divergence. Now, I'm sure all of you have done some sort of divergence studies in the past. And when I say divergence studies, I'm talking about things like divergence in your stochastics or your MACDs or whatever it is you're using or have used in the past. So you know what divergence looks like. So if I draw a line, for example, and the line is doing this, and this is the value line, whatever the value line may be, and we'll talk about that a little bit in terms of gold and oil. If I draw a value line across the charts like this, then the one thing you'll probably be able to realize is that if the rule is you want to buy volume, because the value line is going up, the one thing you're going to realize almost straight away is that if the value is going up and we can get volume at this price, that's probably going to be a buying opportunity. If the volume is also at this price here, that's probably also a buying opportunity. Now there's volume and volume, of course. There is a heavy selling volume that is new high volume levels. And obviously we've got to be careful with those, that there's maybe some supply coming in that we haven't figured out. And we need to just be a little bit patient for some sort of decline in volume. Why is that important? Because what happens in a lot of cases is we've got to make sure that we understand the auction process. What is the auction process about, guys? I'm sure a few of you already know the answer to that question, but let's make sure you do know the answer to the question. What is the auction process about? Very, very simple. A lot of people kind of get this wrong a lot of the times, but when we draw it up, people kind of make sense of it. So let's just draw it up for you and see if you can agree with me about the auction process. The auction process is simply from Economics 101. And it suggests that we'll do it as a straight line. It's actually a curved line, but it doesn't make any difference. The same principle applies. This is what we would call supply. Now, why is this supply? So let's label up this supply line. So this is supply. And the reason why this is important is because obviously you want to try and figure out where in the auction process you are on every single trade that you take. It's got nothing particularly to do with profile. It's just about understanding what profile actually is showing you. So this is supply. Now, obviously, why is this supply? Why does the line slope like this? Well, obviously, if we label the axis, we can obviously see that if we put, for example, volume along the bottom, and if we put price along the left-hand side here, then obviously you'll start to figure this thing out. As price gets higher, supply gets higher. Okay, pretty simple stuff, isn't it? But a lot of people don't really know that. If the price gets higher, then the supply gets higher, and that's normal, isn't it? That's normal. If there's a lot of price, if the price goes up and up and up, there's a lot of people start appearing selling stuff, isn't there? And obviously, if the price drops significantly, you would obviously start expecting supply to drop significantly as well. The price drops to zero, how much supply is going to be at nothing? You're giving away whatever it is for nothing. Supply should be pretty much zero, shouldn't it? Supply should be zero. Now that's not an awful lot of use, but obviously what is useful is if we start to understand the concept of demand, and this is this line here, of course. This is what demand looks like. The higher a price is, the less demand there is for that higher price. That should make perfect sense to anybody that's ever either went to an auction. Obviously, as the price goes up, the number of people with their hands raised gets less and less and less until the last paddle stays in the air and they win the auction. As the price, of course, drops, the demand gets more and more and more. A color television that was $2,000, there's nobody wants to buy it because it's not worth it. But as the price drops down towards $10, there is a queue around the block wanting to buy that television for $10. volume is enormous. Now you might be saying, okay, well, that's all very useful, but how can we use this? Well, guess what this is, guys? It's a volume profile. You will see that trade takes place along this line here. Trade takes place along this line here. Till we reach the middle, and then trade takes place along this line here as well. Okay? No trade takes place out here because you can't have demand that isn't matched by supply, can you? It's impossible. Because what if you want to buy something and nobody wants to sell you? Then there's no trade. There's no trade takes place. If you say I've got a huge demand for 50 of those televisions at that price, and somebody comes along and says, well, there's nobody wanting to sell you at that price. It doesn't matter how much demand you've got. There isn't going to be any trade. There isn't going to be any trade, is there? So obviously that's absolutely true. It's a market truism. Now, obviously, one of the things that can happen on this is that different things can move. Different lines can move at different points. Now, if demand increases, so obviously the volume, you have to go to the right-hand side if volume is going to increase. If demand increases, then obviously what's going to happen is that this line is going to move to the right-hand side. Can you see what happens to price? Price rises with volume, doesn't it? So as demand increases, as demand goes in this direction here, then obviously what happens is that extra demand pushes price higher on higher volume. And you start to see that volume building as we go higher into higher prices. That means that there is demand stepping into a market at a higher price. Your job is to understand and interpret that extra demand and try and figure out what you're going to do with that demand itself. So it's an important part of your trading is that when we start understanding volume, we always try and analyze it in terms of the auction process. Let's take a look at gold. Let's get started on the first chart first of all. Let's take a look at gold. Now, what are we interested in when we're looking at the gold market? Well, I want to take a look at a static drawing of what was going on in gold at the time. This is what was going on in gold at the time, guys. This is today's market. It's this afternoon. And at the gold price obviously is the candles, and we've got a couple of driving lines in the background. Now, one of the things you're going to be asking is, well, what are these driving lines? What kind of sense can we make of what we've got on the screens here? Well, let's take a look. The first thing that we can obviously look at is this first top line, the red line. This is what we call the inflation break-evens. Obviously, it's pretty simple what that measures. It should measure inflation. We know that gold, of course, has a inflation hedge quality about it a lot of the times, and therefore we should be predominantly trying to trade gold in the direction of inflation hedging. The second line is what we call the credit default swap pricing line, and that's obviously a risk line. Credit default swaps are basically insurance policies that institutions take out when risk starts increasing. Well, if we know that the price of credit default swaps is increasing, is that not going to have a positive correlation, obviously, to gold? The answer is yes, it will have a positive correlation to gold, up or down. And the final thing that we could look at in terms of gold drivers is the US dollar risk measure, and that's the green line. So what I want you to think about is, if you know these areas, if you know these lines, and obviously if you join the class, we'll show you what these lines are, we'll get you onto these lines, we'll break these lines down in their entirety to make sure you're 100% taking ownership of these lines, then obviously that's what you're going to start learning. But if you understand it and if you accept, which is obviously a huge leap of faith that you've got to accept what I'm saying, that these lines are positive correlations to gold, I want you to try and make a decision on the right-hand edge of this chart about what you're going to do. Now, obviously, when we're talking about liquidity, we're talking about volume, we need to establish a price. We need to try and establish a price where, if these values are established, if they stay positive, we've got to be able to try and figure out whether we're a buyer of gold at lows or whether we're a seller of gold at highs. And what I want you to do for a second is just think about what you would be trading. Are you bullish gold? These are all positive correlated lines. And your narrative is, well, inflation's a lot higher, so I really want to be doing what with gold? The credit default swaps are certainly a lot higher today. I want to be doing what with gold? And I'm a little bit concerned about the dollar risk measure. However, it is increasing, so I want to be doing what with gold? Well, that's the challenge, isn't it? That's the challenge. You now have a way of being able to look at the markets in terms of risk inflation and the dollar that enables you to then step into the market and say, well, you know what? I can figure out that with inflation a lot higher, with the pricing of credit default swaps a lot higher, and with a small upturn in the value of the risk line from the dollar, I don't want to be selling gold. I want to be buying gold. Now, the next question, of course, and I hope that's your decision. If it's not, you've got me baffled. You've got me baffled. We told you these are positive correlations. I'm really surprised. Anyway, so we want to be buying gold. So what do? Well, we've just identified this concept of round numbers and key levels, haven't we? We identified that by looking at a naked drawing. And we knew that taking out a previous low or taking out a wholesale price level would generate institutional liquidity and order flow. So what you're going to do, of course, is you're going to start watching where the big volumes have came from. You're going to start looking at these areas and saying, you know what, if I could get a little price, somewhere where these big volumes have came from, I might be able to generate some really good volumes. So we look on the chart here, and what I want you to think about is, where would you put your order? Where I would put my order is, I can see that the last big volume candle was this big up candle here, and this big volume down candle here. So I know that there might be some liquidity below those prices from trapped buyers who are perhaps now in a little bit of a risk because the price hasn't developed. Now, I want to be bullish. I want to be a buyer at lower prices. So I want to try and find a seller who's going to have to sell to me at those lower prices to make some money. So what I'm going to do is, I'm going to look at this and say, you know what, I'm going to put in a buy order just off of this 1313 level. Perhaps I'm going to put a few contracts just above it, a few contracts just below it, and I'm going to be looking to explore this area for a buy trade. Based on the value line divergence that we've established, where we can quite clearly identify that inflation is higher, that the credit default swap, which is pricing risk in our markets, is also higher, and that the movement of the dollar risk measure is also starting to generate some upside. If these measures stay roughly positive to the upside, and I get a price of 1313s, I want to be a buyer of gold. Well, this is what happened to that gold trade. You'll see that it's exactly the same chart. Exactly the same chart. It's now actually the actual chart itself. So we've established that if you know that this is where the volume trade is, and you can see quite clearly that this is where it is, this is the place you want to be doing business on gold, isn't it? So what happens next? Now, this is today's market, guys. It's not, you see the dates there, 26th of March. It's not cherry picked from 5 years ago. It's today's gold trade. This is the trade we talked about live in the room with the team. And we were able to talk about this trade as it was happening so that they can see on the right-hand edge. And I said to everybody, what would you be doing? And they all said we would be buying it. We certainly wouldn't be selling it. So let's see what happened. The price then traded down to exactly that price where we had hoped to see the price trading to. One of the things you will be able to recognize is we get a little spike in volume, but you can see the overall direction of volume is actually dropping. That's good news. That tells us that we are in that buyer's auction part of that process. If the volume's dropping overall, that's great news for us, isn't it? That little spike in volume is you stepping into that volume and taking whatever there is available for that buy trade to take advantage of the uptick. Take a look at inflation when you make the decision. It's actually gone higher. Take a look at the credit default swap pricing. It certainly hasn't gone any lower. Take a look at the credit default swap pricing. It certainly hasn't gone any lower. Take a look at the dollar risk measure. It's also gone slightly higher. Higher highs, higher lows, higher highs, higher lows. It's not a lagging indicator. These are not lagging indicators. It's not divergence in the sense that it's a stochastic divergence or a moving average divergence. It's real. Guess what? These lines, the red line, the black line, and the green line, all involve billion-dollar trades in real time. They're not some sort of price-derived lagging indicator. They are real tradable lines. They have a reason. They build a narrative. If risk is increasing, what the hell are you going to do with gold? If inflation and risk are increasing, what the hell are you going to do with gold? I would hope, if you've got any sense, you're going to try and buy bottom edge prices. The one thing we teach in the room very much is to make sure that you always buy at discount prices. Because whilst you might say, well, I'd be buying gold, that doesn't mean you can buy gold at the top edge of this bracket and expect to make money. You've got to insist on a discount because that's how you're going to be in business for a very long time. You get a big discount on your gold price. You've got some real, tangible, definable value. You've got a narrative that makes perfect sense. Why are you buying gold today? Why are you buying gold at the bottom edge? Well, I can see that the inflation break-evens are going higher. I can see that the pricing of credit default swaps has taken a spike higher as well. All of a sudden, you sound like Bloomberg's. All of a sudden, you sound like Reuters. All of a sudden, you're having a conversation with the marketplace that's real. It's tangible. And if you said that you'd be a buyer, congratulations, because that's what the trade was. The price then rallied off of that price. I drew a box for everybody on the charts here saying that that's where some institutions would exit out. The guys will know that. That was a live conversation in the room. The price then traded to that exit price almost exactly, and the price rotated back off a little bit when you started to see the credit default swap coming off a little bit and the dollar risk measure coming off a little bit. You can see that the price then tailed off a little bit before it then started to rally back to the upside for the retest into the highs. But by then, the credit default swap is now dropping. The dollar risk line is now dropping, and obviously inflation has stuck to the top edges. That's the only trade. Guess what, guys? If you agreed with that trade, you've taken a huge step forward to realizing this is possible on the right-hand edge with just knowledge, simple knowledge. Without even looking at the order flow of that trade, it was still the right trade to have. Let's take a look at a second trade. This one is in oil. Now, the one thing you're able to recognize straight away is there's two lines on this occasion. The first line is again, we're looking at inflation break-evens, which is the blue line, and we're obviously looking at the orange line, and that is value. The pink line, that's value. And this is when we talk about gold being cheaper, oil being cheaper expensive, we always value it against this pink line. Now, one of the things you're going to be looking at is, well, when is this value going to start biting? Well, what we need and what I'm going to ask you for is the simple rules of the two lines have to diverge against price for you to take a trade. That's it. When you start trading, you'll start to understand that it's not always about hugely complicated order sets. It's about two lines diverging against an up candle. What can be difficult about that, guys? A lot of people think this is like drinking from a fire hose. There's a lot of information. It's only one or two lines, guys. That's all we're doing. When we do the exercise on the S&P, it's still only going to be one line so that we can get through the exercise before we all expire. So obviously all I'm going to be talking about here is wait for the two lines to diverge, have a think about it, think about what the trade is, and execute. Does everybody understand what the trade is? If the two lines diverge from price, execute. If they don't execute. If one line diverges and the other doesn't, don't execute. Leave it. Wait until a good trade sets up. Let's see what happens. We'll scroll along the lines. The blue is still going up. The red line's dropping. So I want to be in a sell trade, but I can't. I can't be in a sell trade because we've obviously got this measure for inflation, which is our break-evens to the upside. And obviously we've got to be patient with that. The blue line is still rising. Are you selling, guys? No. I'm getting interested. Why? Take a look at the volumes. Volumes dropping. So we're in a seller's auction. So obviously that's a great sign for a sell trade. We just haven't seen enough value for the sell trade yet because the inflation line is still suggesting a little bit of possible buy side coming in. So we don't want to just sell off the 60.25 level, even though it's a wholesale price level. This is one of the oil wholesale price levels. Quarters, halves, 75s, and wholes. So this is one of our wholesale price levels, $60.25, but we can't sell it because we haven't got those two value lines agreeing with each other. Let's take another candle. Blue line still rising. We still can't sell it. Let's take another candle. What do you think of this candle, guys? Well, number one, you can see quite clearly that we have that very, very significant macro divergence in the background. Would everybody agree that this is still very, very bearish? I know it's turning up a little bit, but you've got to put some context to this. Does everybody agree that that is a very, very, very bearish line right there? If you agree with that, you'll also agree that this is a very, very significant turn-off of that top edge. So the short-term measure that was causing us to stop selling it, even though we wanted to sell it through this whole process, this was stopping us selling it until this downtick here. If you agree with me on this, and eventually you'll obviously get to know all of these and you'll be able to put together your ideas on this trade, if you do agree with me, there is your sell trade right there. If you're now seeing that, this is now your sell trade. You've now got your deal. You've just taken out $60.25. Let's see what happens. The price goes up a little bit and then drops off of that level beautifully in the direction of the big macro divergence, and then we get this perfect collapse here. And we drop obviously from a high print price here of $60.35 down to a low print price there of $59.90. That's $450 profit in around about half an hour. Did that divergence allow you to make the correct decision? If we look at the big picture here, without the blue, you'll see that the only trade we should be doing is selling oil. You'll see that that trade changed in this area here. This is called a guaranteed premium. We always want to sell prices that have guaranteed premiums in them. In other words, the price is way beyond a small turn up on the value line. If you sell too soon on this, then obviously there's always a chance that the pink line can turn back against you and you can end up getting into a difficult trade. So one of the things we teach is how to define that you've got some guaranteed premiums or you've got a guaranteed discount on any trade you take. If you agree with me that that valuation here is so fecking obvious, you've just made a huge stride forward in making thousands of dollars every single day on oil. And we're going to finish off these classes. If you agree with me, of course, you don't have to agree with me. You might say, I don't see that trade. Well, fair enough. You can't make you see the trade. It is what it is. Some people might not think there was enough divergence. That's open, obviously, to debate. It's up to you. But if you're going with the simple rules that I gave you earlier, that there has to be some macro divergence, some short-term divergence, and when you see that, some levels that you can work against, then you'll agree with me that that is absolutely a sell trade. Let's take a look at the S&P, because obviously when we look at the S&P, we're going to be looking at a lot more examples, because we're basically going to cover pretty much 4 hours on the S&P chart, and it's going to be on a 5-minute chart. And I'm going to be asking you to make decisions right through this process based on one value line. And this is going to be huge, because obviously if it's based on one single value line, guys, just one value line, then obviously you're not going to have to decide whether one's more bullish than the other or whatever. It's just simply, do you see divergence and do you see a level, and have you got some supporting volume analysis? Divergence, a level, and some sort of supporting volume analysis. Let's take a look and see what kind of trades we can make out of this. Trade number one, the start of the US session, 1:30 London time. The red line is the direction that the market should be going in. In other words, this has a positive correlation. So what's your opening trade right from the gun? I would hope most people would agree with me that the opening trade from the gun is a bullish buying opportunity from the outset. We don't see anything else. We don't need to wait for anything. We don't need to wait for volume, because there's always going to be volume on the cash open. Always. So there's going to be commercial interest, and it's bullish. So you can buy from the gun and try and take advantage of the opening play. The price, you can see, immediately rallies very significantly from that US cash open. And this is today's market, guys, on the S&P. Rallies from the gun straight away. Little pullback here. So if you're a multi-lot trader and you like to add into your positions, you would obviously use that as an opportunity maybe to buy some more. And obviously the trade continues north beautifully. When we start seeing this divergence appearing, look at what's starting to happen here. Divergence. We start seeing the price coming up into this level here, which is number 1. Why is that not a sell? Why is level 1 not a sell? We've got divergence at a slightly higher price, but why is it not a sell? Why is it not a sell? I want you to think about this. We're in a seller's auction, of course, because you can see the volume's dropping. But if you're going to trade in the same direction as the big commercial houses on this trade, you want to see something in volume terms. If you want to see something in volume terms, where is the sell most likely to be located? Now, what we've done here is we've marked off the key wholesale price levels of 20, 25, 30, 35, 40, okay? These black dashed lines. If we know that the black dashed lines contain natural volume in the S&P markets, the one thing you'll be able to recognize from this is that there doesn't seem to be any key levels against this level, is there? There's nothing particularly key about this. So therefore, you should naturally be leaning, if you agree with me, if this divergence stays in play, you should be naturally leaning towards a short trade off of that price of 28.30s. Is that a reasonable narrative? Well, think about what you've just achieved that you maybe haven't been able to achieve before in your trading, guys. From one single piece of information, you've now got a sell trade resting just above a top edge at 28.30s at the moment, with a narrative developing in the background that makes some sort of narrative sense to you. Is that not a huge advancement to what the divergence on a stochastic tells you, or the divergence on an MACD tells you? It doesn't tell you that there's actually billions of dollars getting sold here. This red line does tell us that. The red line tells us exactly that. There are sellers coming in, and therefore if we can get a higher price, and we can lock in a premium, and we can lock in some volume, and we know where the volume's located because we've already established that volume is located at round numbers and halves, we should be able to make money by selling this price level. Let's see what happens. The price then trades up, comes away from that level a little bit, drops down. You can see that the price actually goes bullish again. So if you fancied going in for the trade again, you could obviously take a pop at some buys here. You can see obviously that you could take a pop at that because the market is definitely bullish at this stage. And obviously you could have taken a potential buy trade, and guess what happens? See what happens at number 2. Now look at the volume. Do you see the increase in volume now, guys? You see it? Now we've got commercial volume coming in. In addition to which, we now see that from the top edge, we've got 1 point, 2 points, and 3 points diverging off the top edge. If you've ever used divergence before, you'll all agree with me that that is divergence. Now we've got a key level. Now we've got divergence. Guess what you now have as well? A sell trade. Is that really that difficult, guys? Is that difficult to get that trade on if you now start working some prices against that level? Seriously, I want you to think about it, and I want you to answer honestly. Is that a difficult sell trade for any of you to get on the books? You knew where the sell trade was going to be located. We were able to draw a box where we thought the sell trade was going to be located. You can then start drilling down into your order flow to find the right elements, like a node, a volume node in that area. You can look for exhaustion beyond that volume node and then sell as the price reverses back off the exhaustion. But what we can define is that this is definitely got some short-term sellability in it based on the value of the overall shape. Now, you might say, well, what happens if the red line explodes to the upside? Guess what happens if the red line explodes to the upside? You get stopped out for a loss. That's what happens. And you maybe lose 2 or 3 ticks, guys. That's all that happens. You're playing probabilities now. You're playing institutional probabilities. So what does happen? The price goes up a little bit, starts rolling off the top edge. You can see the red line actually starts diverging here. So if you did get stopped out, you take another pop at some sell trades. You go again because the value is still there. The price is slightly higher. You go again. Because you're playing probabilities, guys. It's not an arbitrage, it's a probability. So you go again into the trade, what happens? The price then sells off that. Look at the red line, collapsing. What happens? The price then collapses off of those two sell orders, and you've ended up with an enormous profit off the top edges here. We're obviously going to wait for the next opportunity to develop, and we'll see it just here. Trade number 3. Okay, where do you think price is going to go? Bullish or bearish? Well, this is not an easy question, because obviously if we re-anchor this low here, you can see that we've got this lower, this higher low, higher high over the last couple of little legs here. It didn't happen here. We had lower lows, lower highs, and that's why these sell trades made a lot of sense. This is a difficult trade. The previous high, of course, is at number 2. There is huge value divergence at number 2. So if you're looking at number 3 and saying, what should I be doing here? It's very simple. You should be looking across to where the last time you were able to get a very simple price level and realize that's currently the day high right there. There's going to be liquidity above that price. There's going to be. It's the previous day high, guys. Or not the previous day, it's today's high. There's always liquidity at previous day highs, previous day lows. So if I'm looking at this big picture divergence, I know that if I'm going to be a seller again, I'm going to be looking at this price area here for opportunities. If it doesn't work, I'm going to go back above this top edge here, and I'm going to look just above here. If I get stopped out for a loss of maybe 3 ticks, I'll go again just into this top edge and we'll see what happens. Let's see what does happen. The price trades up to number 4. Guess where number 4 is? It's a breakout of number 2. Divergence is absolutely spot on perfect here. The volume doesn't seem to be as big as we thought it probably would be, but then we are moving away from the open. So obviously one of the things that we can look at is that this is definitely a first starting point for a sell trade. We can see that there is absolutely divergence in the big picture. And the marker that we've got on the charts is also a very large volume marker that obviously we were very, very mindful of. We thought we'd get bigger volume at 4, but we've got to start somewhere. It is definitely a sell trade if everybody agrees with me in terms of divergence principles. There is no question that it's a buy trade. If you can all agree with me that there is no way that's a buy trade, then obviously you've got the ability to step into the short trade and see what happens next. The price instantly sells off within this is a 1 minute chart, by the way, guys. So what happens next? Let's carry on now through the process. The price sells off. Let's take a look at number 5. What is number 5 all about? What are we interested in number 5? Look at the macro and look at the micro. Look at the macro picture and look at the micro picture. The micro picture has this top edge forming, and we can see that we're getting selling coming in. The macro picture says a very, very strong sell side response. The price is also generating some liquidity based on the fact that we've just taken out this previous little level here, plus we've just gone back above the wholesale. Number 5, if you agree with me, is a very obvious selling opportunity. There's divergence, there's levels, there's the macro in the background. This is a sell. If that sell doesn't work, where's the next opportunity? It's going to be above number 4, of course. We're not going to do any other price unless we go above 4. If number 4 doesn't sell off and we've still got value, the next trade is going to be up here. And each of those trades would have been losing trades. Well, guess what? It very rarely ever happens that you get losing trades on these. Let's see what happens to the sell at number 5. The price instantly, again, sells off. Look at what happens to 4. Instant sell-off. Look at what happens to 5. Instant sell-off. Why? Because this is how commercials trade. They value the markets. The algorithms then step in, take the trades. The market makers then expect and understand that the commercials are taking an interest. The market maker withdraws liquidity on that side of the book, and the price sharply falls or rises away from that commercial order. Simple, isn't it? Simple. Fast money response, stops at break even, +1. You're in great shape. Let's carry on now. Let's carry on. What about number 6? What about number 6? Well, number 6 is actually quite interesting because a lot of people will look at number 6 and say, well, interestingly enough, Ray, we've actually got a small divergence at the bottom edge here. We've actually got a little small divergence at the bottom edge, and I can see some micro structures coming in here that could lead to a possible buy trade. So it could be, but it's against the big buy, the big sell side macro. So I don't particularly like it, but if you took it, guess what? You wouldn't have lost any money, so long as you got the price you were looking for off of number 6, because the price rallied enough, two and a half full points, guys, you would have made 10 ticks worth of profit. I'm sure you could have got a stop into break even +1 on the trade. But I don't particularly like it because I don't like trading against the macro ever. So but I don't particularly like it because I don't like trading against the macro ever. So obviously number 6 is a little bit ropey, a little bit difficult, but I don't particularly like it, but you wouldn't have lost any money on it. Okay, let's take a look at the next trade. Some people might say, well, what about this opportunity? Because the red line actually makes a slightly higher high on that occasion, I'm not putting a sell arrow in here. Again, if you misread that, if you took it, you certainly didn't lose any money on the break above here. If you took it, you didn't lose any money. You see it immediately sold off. But I wouldn't have taken a trade because there wasn't any value divergence on it. Okay, so let's carry on. What about number 7? What about this low at number 7? Well, interestingly enough, we actually have quite a nice break to the downside at number 7. We've obviously got a failed break-even trade here as well. So obviously, we're looking at the overall shape here. We can obviously draw that line there. And you can see that from number 7, we have some short-term buy-side divergence on this downtick against this previous low. There's the red line low. There's the new red line. So there is some divergence here. We could draw that divergence easily. However, it's against the macro again. And therefore, if you decided to take it, it's a risky trade. Short term, there's a bit of selling coming in. Longer term, there's a macro short coming in. I don't really like it. There's too many elements that are wrong about this trade. As it turns out, the price went up. You would have been able to still get a break-even trade. Worst case scenario, scratch out the trade and stops at break-even. And the price then reversed off the level and traded back down. So here's another trade, trade number 8. Now this looks a lot better. Why does trade number 8 look a lot better than trade number 7? Well, for one key reason, that the red lines actually short-term started to turn back up again. So after this failed auction in here, we were obviously then able to look at this as a possible buy trade. The price is better, it's lower. We're getting closer to liquidity at 25s. The volume actually looks quite good. And the short-term value line is actually going in the direction of this intermediate value now. So I'm quite happy to take a pop at that lower liquidity off of level number 8. There's a buy opportunity just there. What happens next? Let's see what happens. The price immediately goes into profit on the next 1 minute. The price then trades higher over that period, and we end up with this very nice break to the upside. And obviously the value starts to reverse back off of this top edge, and we start waiting for the next opportunity. What is the next opportunity? The next opportunity must be a sell trade at the moment. And obviously what we're going to be looking for is some sort of value line divergence. We know where the value lines are because we can draw straight lines, guys, surely. So obviously we've got to be looking for those value divergences. This buy trade's actually ended up making a lot of money. It's ended up making a lot of money, assuming you didn't take it out just at this point. Look at the value line go now, guys. Holy fecking moly. Unbelievable, isn't it? You might be saying, okay, we're back in that same position as we were in before off of this previous swing high here. Absolutely. We've now definitely got some bullish order flow. Well, that number 8 ended up making a fortune in terms of trade swings. A fortune. So obviously we can carry on now. Now, what about number 9? Take a look at trade number 9. Now we're at the very top print price. We've now got macro divergence in the background. We've now got short-term divergence in the background. We've now got premium prices against the high print here. We've got a little surge in volume into the top edge. Is there anybody that doesn't think that that's a selling opportunity? Seriously. Does anybody not think that that's a selling opportunity? Even the guys that trade price action, candlestick patterns, would say, wait a minute, we've just got a little spinner right there. That's a definite sell. Well, guess what? It is a definite sell. It's a definite sell. It looks like a sell. It looks like a sell. What happens to that trade? It drops quite nice. You could have certainly have got a stop to break even, and what happens next? You get stopped out. Look, if you put your stop at break even, if you were just below the black line, you just get stopped out on this green candle right there on the right-hand edge of the chart. You got stopped out at +1 though. But what would you do at number 10? Well, the value is getting better. Take a look at the value. It's actually getting lower and lower and lower. And the volume's now dropping off the trade, suggesting, of course, that that's us in a seller's auction. What would you be doing at trade number 10? I would hope, if you're sensible and you've understood anything we've been talking about, you would be getting ready to press the sell button. You would start looking at your order flow and you would start working prices on your order book to get a short trade against that value. And if you did, this is what happens next. The price instantly sells off the level like an absolute choo-choo train. The same type of fast money response that we saw from trade number 5 and from trade number 4 and from trade number 2, all off of these top edges. That fast money response is unbelievable. And when we look at the trade that then develops from trade number 10, you can see we get a very decent response and the price absolutely collapses in line with value. Let's take a look at the final trade that we're interested in. Trade number 11. We've got a top edge here. We've taken out the liquidity. We've got short-term value divergence here. We've got macro value divergence here. And we're at trade number 11. What's your trade? Does anybody not think that that is a sell trade opportunity right there? Is there anybody that doesn't think that that's a sell trade at number 11? Of course it's a sell trade. Of course it is. What happens next? That's what happens next. So when we stop a second and think about this, if you agree with me that these values are usable, if you agree with me that every single trade we've talked about here has a level of relevance, has some sort of reference in terms of its volume, if you agree with me that you can draw a straight line on your charts across a previous swing high, and if you agree with me that it's possible to then analyze and identify divergence against key levels that might be on the charts from previous highs or are provided by simply the wholesale price levels. If you agree with me that it's possible to do all of that, my friends, you've just traded every single one of those arrows. If I take the value line off the charts for the time being, if those were your trades today, and guess what? These were our trades today. If these were your trades and you agreed with everything we've shown you, then obviously I've set out to do what I suggested I wanted to do at the start of this presentation. And what that was very, very simple. My objective was at the start of this presentation was to show you a way that inside of that process, that it was possible, number one, to get rid of all your lagging indicators. That's the first thing. Did we succeed in getting rid of all the lagging indicators? Yes, we did. Does this indicator lag? No, it doesn't. It doesn't lag. The red line does not lag. It's real time. It doesn't repaint. It's a real time line that is appearing on your charts. Are you able to read divergence on this line is the next question. If you're not, perhaps this course is way too advanced for you, but I'd imagine that pretty much every single retail trader can read divergence. So if you can draw a straight line on your charts and you can read divergence, you would have had every single one of those trades. If you had every single one of those trades, from the start of that session to the end of that session, and the period of time, by the way, guys, the period of time is only from the cash open at 1:30 through to this area here of around about 1600 hours. It's not that long. It's not even a full session. It's up to the US lunchtime. If you traded one contract and you maximized, of course, if you maximized the profit on that one contract, you'd have done $2,775 on those trades. $2,775 per contract if you traded those particular trades. If I've shown you that by using this value line and by using the concept of liquidity, the concept of key levels, the concept of wholesale prices, if I've shown you that even at this basic level that you can consistently make the correct decision, and I've shown you it on oil, I've shown you it on gold, it's not cherry-picked, it's today's markets. And that finally, for the first time perhaps ever in your life, you've got an actual identifiable edge. Because this red line is not price derived. It's got nothing to do with price. And you might find that amazing to believe, but it's got nothing to do with price. It's not derived from price, guys. Then I genuinely believe that you've got to start looking at this and saying, this works. This is real. This gives me an edge that I can actually verify. And if you disagree with that, I'd like to know exactly why you disagree that there is no edge from this information. Why is there no edge when this red line's collapsing and we get a top edge here? Why is there no edge in that opportunity? Why is there no edge in this opportunity at number 11 when the big picture is collapsing and the short picture collapses as well and we get a previous top edge? Why is there no edge in that opportunity? Doesn't make any sense. In other words, there is opportunity. There is a genuine, tangible, tradable opportunity in real time developing on these screens. And it's not just in equities. It's not just in oil or gold. It's on your Forex markets. It's on your natural gas markets. It's on your agricultural markets. It's in your treasury bond markets. It's in every single market you could want to trade. And obviously all the markets that we teach, and we teach you all of these lines. This is just one line. We can add other lines to this picture. We can obviously add other elements to this. We can look at the price of credit default swaps. We can obviously look at all of these types of things to see how much risk is coming into the markets. We can look at some market internals to try and figure out whether we're starting to see some buying and selling pressure. So we can enhance this. This is the starting point. Well, if the starting point makes you $2,700 on a single contract in one day for a half a session, think about what the enhanced version could make you. You might not have taken all of these trades. You might have thought a few of them were a little bit borderline in terms of whether you had divergence. I would disagree with you, but you might have thought there was a few borderline decisions in terms of divergence. I don't see any of them that are even close to borderline divergence, and we'll spend a lot of time in the classroom talking about what divergence really is to make sure that you can see divergence properly. I don't think anybody would disagree that there wasn't divergence on any of these trades from the macro perspective or the micro perspective. And if you do, I despair. I despair. That's what we do, guys. We teach you about value. We teach you about why value makes sense. We teach you what the narrative of this line is all about. It's not just a line. It's not just an indicator. It's a narrative. We showed you that the lines mean something in gold. We showed you that the lines means the pricing of credit default swaps. Very important. We told you that one of the other lines on gold was the price of inflation. The break-evens on inflation are very important because gold is used as a hedge against inflation. And when we can put all of these pieces of the jigsaw puzzle in our favor, and we get a discount price or a premium price, and we can then look at things like the order flow to find the volumes and the price action that develops off of those, and we can see the commercial activity at those prices, you've got a real, genuine, and tangible value that you can take into any market situation on any time frame and make great quality, high probability decisions on a day in, day out basis, every single day of the week. And it's up to you how often you trade and what markets you trade, but we'll show you how to do it on all of them. I'm going to finish off at that, guys, because I went way over my time. I said that I was going to try and get this finished inside an hour. It's now 2 hours. I apologize again for going way over time, but we had to get through it. I wanted to get through it. I hope you decide that this is actually worthwhile. I hope you decide that this actually makes sense. If it does, I really look forward to seeing you. If it doesn't, I really do genuinely wish you all the very best in your trading going forward, whichever direction you decide to take it. But just do us a favor, get rid of those Fibonacci's. They don't mean anything. They never have meant anything. And you just can take a huge step forward by stopping all of that nonsense on your charts. Start learning the real stuff. Start learning about volumes and deltas and price action, key levels, wholesale price levels, and activity, commercial activity off of key price points as well. In the meantime, have a great night, guys. I'm going to get off here because I've still got work to do to finish off. And I'm out of here. I'll leave you in the capable hands of Kim. She'll take you through what you need if you want to get involved. If you don't, as I said, have a great time. I'm going to say adios amigos, arrivederci, auf Wiedersehen, and spasibo.
Thank you so much, Ray. Excellent session. Excellent session. And I don't think anybody minds. You were covering a lot of fantastic information. It's very, very valuable. And as I said up front, guys, you'll see why we always say Ray's not your typical guy. But I would love the opportunity to share with you guys the details of the upcoming class. So I'm going to take Ray's chart away, and I'm going to go over here to the slides, and we'll go through and we'll answer questions. So I'm here for a while, but thank you. Ray's already left us. I know we'll see Ray in the morning, right? Right, guys? Anyway, so we've got our spring training trade schedule coming up here, and we're starting next Monday, April 1st through May 3rd. That's the full class. The 1st through the 5th is going to be order flow and equity. I think Ray showed you what he's going to be covering in there, but I will talk about, the different things there as well, because as he showed you, a lot of really, good stuff's on equity and, getting you up to speed, making sure that you understand the market maker, pricing of equities, going to have event horizons on stocks, short-term volatility, long volatility, and then in the order flow, he's going to go over uh, the uh, the tools that David's created, so you'll be able to learn from those. For a number of you guys have joined us for that. The market makers model. He's going to go through the interns exercise, which is super valuable. It's exactly the same exercise that when he has new folks coming in to intern with him, uh, that you can get, and how to build a simple model and exhaustions and all kinds of different orders. I'm going to cover those. Then the next week, we're going to go into fundamentals and technicals, bonds and currencies, crude, index, ags. The last week, he'll spend a whole week, putting together the institutional trade process so that you'll kind of know at that point, what you want to work on, what you want to master. A lot of our traders will tell you that focusing on one market, exactly how you start mastering that to get you up to speed. I think a number of traders have said how valuable the intern exercise is because it really teaches you those processes, teaches you how to be on the right side of the market and to read the market properly. And let's see. So there you can go to compassfx.com/sharp trade if you want to get those questions answered. Oh, or actually, that's for the full package. The full package is $14.97. And Martin wants to know how much is the order flow indicator suite? Well, you can. We have a couple options. I'll cover those for you, Martin, here in a second, so you'll understand how you can get that. But as Tracy's pointing out, I'm going to show you how you can get the order flow that included in your package, which is the best value. Ray talks about value. We want to make sure we keep with that theme for sure. And one of the things I think you could see that Ray's talking about is 100%. I saw this the other day, and they talk about in the media, business, and information that it's better for them to be right than to be first because sometimes you can get out there first with a story, you haven't done enough work, and guess what? It comes back and it bites you. So That's not a good situation. It's kind of the same thing with trading. Like Ray really tries to break new traders that are coming into the group from fading the markets because you're trying to kind of be first to the market, but he's teaching you how to build those narratives so you can learn to be right, because sometimes even though he's saying you want to be at a discount, you're going to learn how to have that discount, but you're actually, it may feel like you're paying up for price, because he really, really wants traders, when they're learning in the markets, not to be worrying about trying to be first, but learning out to have enough elements that you can be right and you have enough probability and edge on your side. So that's super important. And as we were showing there, for you, Martin, if you want to have the equity program and the order flow, and you want that cool little indicator, you can have it included. And along with this order flow and equity class, you can get the full package, which will include all of those bonuses and an extra month in the trade room with Ray. So that saves you, an extra, what does that save you? An extra 500 and some dollars there. I had it written down, but five, oh, well, I think there it's like 597 or something like that. So that's nice little savings. Oh, it'd be 547, right? Um, and here's our schedule. So each morning you heard Ray talking about our morning session being in there in the trade session. Every morning Ray puts up his uh, charts and stuff during London. He does have obligations with his firm, so he provides commentary as his schedule permits. But we start our regular session at 8 a.m. Eastern, where we kick off. Normally, by the time I come in, they're already, rolling. We have quite a group in during the London session. Yeah, there you go, Tracy, 547. So we have the same math. I was having to count on my fingers and toes there. And then we have a daily ongoing training session, which is really great because what it does is it takes what Ray's been seeing in the market. So the content that he teaches adds more context. And then so that during the class, we have a number of our, guys that are actually, they trade, that, that's what they're doing this for, is everybody's trading to make money. So he goes back and repeats it. He says it during the morning session, but then he'll go back and repeat it. We actually record those sessions. And then during our um, session from the April 1st through May 3rd. We will have class sessions on Mondays, Tuesdays, and Thursdays at 3 o'clock Eastern. So 3 days a week, you're going to have additional class time as well. All of those get recorded, uploaded in the members area, and you'll have continued access to those. So that's what you have there. Now let's just say that you're somebody that says, you know what, right now, I I really want to spend time on the equities and the order flow, what he taught there, and I want to sign up for his Smart Alpha so that I can follow his trades on Smart Alpha, but I'm going to learn enough during that session. You can sign up for that, compassfx.com/sharp6. Well, it will cover both AP, so it's going to be covering the ES along with actual stocks. The equities long volatility and the buyback will be on in stocks, but during the order flow part, that will actually be, he will absolutely be covering the ES. So that'll get you on both. Now let's say here's exactly what we're going to be covering in order flow. He's going to be talking about structure, absorptions. You heard him talking about levels and rotations and spreads and capping, that intern exercise. And then we're going to have stopping volume and all of the different things in the structure and stuff that goes with order flow. The important thing is, as you can take this class as a standalone. For those of you that continue and go further in depth, that's why the full package is absolutely the best value, not only for the money, but you're going to pick up so much information. And right now with that package at $14.97, it includes the indicator for that's $297, and you can only buy the indicator. You cannot buy it separate. It has to be bought with the class. So that's like a $494 value there. Along with the strategies, you're going to have the trade exercise. You're going to learn the liquidity, L2, the targets. That's one of the things, and measured move we don't have on here, but measured moves teaches you to really see in the market where price will be going. Many people really struggle with that. Okay, I'm in the trade. What should I be targeting? How do I know if I should be getting out? And I saw somebody ask that earlier. That's probably one of the biggest questions and the hardest part. It's easy to get in the market, but should you be staying in the market? Should you be getting rid of the trade? And being able to have that all and have an understanding is going to really add confidence. As Ray talks about the why, I think, um, lots of people teach you how to trade, but Ray's going to help you build your narrative, which builds your confidence because you know why you're in the trade, you know why, what's happening, why it's happening, where it should be going, and why. So that's going to help you stay in there. The before she goes, that comes into play with the squeeze trades and all of these difference. I've got there the fade versus a squeeze. Ray doesn't want you fading the market. He wants you learning to, you know, wait, just like the newspaper, making sure you're right versus being first in the market. So there's a few of the strategies that you're going to learn from the order flow class. And yes, as Kevin's saying, we spent quite a bit of time today. The guys that are in the room will tell you, it was great. It was just a, bar by bar, price by price, being in there trading uh, quite a bit this morning. We spend a lot of that time, it's quality time, really learning these auction processes, learning how to read the market, why price is where it is. So I think that's super, super valuable. I think that full package right now with the bonus and getting that extra month, someone like Kevin, because Kevin came in during an early bird special a couple years ago, he can tell you how valuable having extra time with Ray was for him. And as we were talking about on Saturday, now I think listening to Ray, doesn't that come back full circle? Now that you're listening to Ray, if you sat and listened to David the other day, what comes first? It's that old chicken and the egg. Well, you need the knowledge. The indicator doesn't know something you don't know. Let the indicator, instead of force fitting these parameters, learn to be able to, let the indicator do its real job, which is to aid you into seeing and what you're seeing and helping you. It becomes a real strong, um, aid for you. I'm going to call it your personal assistant. So it's going to be a very, very powerful guide and a very powerful assistant for you. And then, so after that, we're going to then move into week 2, which will be fundamentals and technicals, more trade strategies, really honing in that, the matrix, the market matrix, and further understanding commercial order flow. You can get this package for $14.97. It's the sharptrade.com. What you'll want to do with that, because you do get the indicator, which if anybody knows, that indicator is sold out there. If you were to buy the indicator package, which we're probably not very smart, we probably should just be selling this as an indicator because you guys would be lining up, like crazy. But Ray wants you to get off there. He wants you to understand what you have, the power of the actual tools that you have. He wants your brain to be, he always feels like you should be able to do and read this without any indicator. So that's where we're going to be on that. I think Sean from the class wrote in. I thought it was really funny. He's like, any trader that I meet, anybody that has a few brain cells, he's always recommending this class. He thinks that some of them don't come in because they think it's going to be work. So, there's just, the traders that have been in there will tell you they put in the work, but so many of them are having tremendous success. And I got an email from Nick, one of the guys that took the class. He wanted to go on and start working for an institution. He lives in South Africa, and he's worked really, really hard. And he is now an intern at an institution. And he says race training has been so valuable to him. He's wanting to get on the trading desk, and he's so happy because, he's been sharing with, the top guys his narrative, and he says that it's really made him feel good. So I think that's an important part. Then we're going to get into bonds. And some of you are saying, but I don't want all these other markets. I just trade the Forex. One of the things that Ray's going to talk to you about is how important understanding what drives the FX and all of the fundamentals. So that's going to be super, super important for you. He spends a lot of time in the FX and then getting into that. If some of you are saying, but I don't want order flow. Well, he really takes this from the very top on down. He thinks the order flow is going to teach you how to have really stops that so you can make more money off of your work. So you're with every week you're going to really learn the drivers and the specific setups for each of these markets. And the week 4, we're going to be, we have a number of guys that trade crude that and trade natural gas, and they know how to prepare for those weekly reports. For some of them, that's all they trade because it makes them more just off of those reports because they know how to get positioned properly. We've got crude, index trades, ags, market drivers and setups again. Then the last week we're going to do a review, class summary, institutional, putting it all together. So that's the full package. I just thought it would be really important to walk through each of these so that you can see that. But one of the things like I was talking about, I love this point, and several of our guys have talked about, people kind of overlooking Ray because he's not selling you something that's saying, wow, you take this trade and it's going to be worth this much money. He's giving you knowledge, and I just don't think you can really overlook, if Ray disappears, you can continue to build off of this knowledge. And but opportunity gets missed by most people because it's dressed in overalls and it looks like work. And I really feel like that's what happens. We should have people beating down the door to get to Ray. I mean, how many institutional quants do you know that are out there willing to show you how these algos work and how the high frequency trades, how that affects the markets. There's a lot that goes into what Ray covers. So, for those of you that want the fast action bonus today, and let me talk about these bonuses. Make sure that I don't skip over this. The bonuses are going to disappear tomorrow. So, I extended them out because I thought, you know what, I'm going to go ahead and extend it from last weekend for the week because Ray was doing a session tonight, and I thought, well, some of you may wanted to hear him a couple times. I'm giving you an opportunity to grab these bonuses. So get in here, take the full class for $14.97. You're going to get extra month. You're going to get to come in early. Just like Stacy was saying, he's so happy that he did because he's got his charts set up with his package from David. He's been able to spend time in the room. He's going in the members area and starting to work. And he just said it's just been a breath of fresh air for him. He just can't believe in the mornings when he sits and listens to Ray. So make sure not to overlook this. The suite that you get with the package, it's going to have the auction bars. You can see this full list. It's an incredible package. Now the market maker, the yields package, that has a separate, a couple things require a separate subscription for data because you've got to have live data on it. The rest of it you can run with your package. I think you're going to find that to be extremely valuable. And what you'll do is you're going to find, just like David showed you on Saturday, if you missed that, it's up on our site. You can listen to his recording. And Ted, a quant, if you go and search what a quant is, they're the guys that build the trade models for the banks, the institutions. So that's why Ray teaches you how to think about building a model and what things to put together, and teaches you how to explore on your charts. So the quant are the most sought after people in the financial markets. The quants are the ones that make the people like Warren Buffett and all of the big hedge funds. That's who they search after. So Ray's an institutional quant for a couple, I mean, he has a firm and he builds these models for the bank, for one of the large banks. So like when somebody has a model, he's able to do it backwards and tell you, what's in it. He teaches you how to, have the probabilities and the edges that you need to trade so it's not gambling. So we've got our special today. I think Martin earlier said, how do I get that indicator? You can get the indicator for a special price of $4.94 if you just want order flow and you want the suite. So you've got those options you can save there. Absolutely, Ted. I'll be happy to give you a call, um, or Tracy can give you a call, because we'd love to have you get signed up. So there's the 3 different packages all on one slide. That's probably easier. We'll get to that point. I can go back now and, search for any specific part if you have questions. Julius has a great question. Thank you. I'm so glad that you asked. The package that David built, the indicator suite, runs on Sierra charts. So on that, it's on, so, wherever you can use Sierra charts, there's a number of firms. And we work with, like Infinity Futures. Patrick at Infinity Futures, he's very familiar with, they use Sierra charts. He's familiar with Ray. I was really pleased he came and sat in for a couple months after Josh left. He wanted to, kind of learn more about what we're doing. He was very impressed with what Ray teaches. And so Infinity Futures does a great job of providing, um, different videos for how to use Sierra charts. And Tracy arranged with Sierra charts to be able to get a demo and a discount with Sierra charts. So, because you'll want to run the level 5 package, their full package. But you can get our ultimate trade class for $14.97, which absolutely is your best value, because right now you've got bonuses that you can get, um, where you can save, get the indicator. You also get an extra month. That's going away tomorrow. You can still sign up, but then you'll need to buy the indicator for $2.97 after that. And then if you want, after the class is done, to continue, you would add a subscription for $2.50. So if you're sitting on the fence, get off the fence, because the bonus is going away. I know, Rick, he really did. Josh went to the dark side. He went to the oil patch. He really did. He really did. I really enjoyed working with Josh, and Patrick's been fantastic to work with. I really like working with them because, they've built their business the same that we have, I feel, around customer service, understanding their customers' needs, making sure to, you know, work with them. We work on the education side, and so I like having Patrick, because he did actually took the time to sit in for quite some time. He'd sit in the room so he'd have an understanding what you guys as traders would be doing when you call and ask him, saying, hey, what's the best type of account, and that would fit for my trading. Oh, that's fantastic. And Rick's given him a shout out. He's been his rep for 5 years. I really like these guys are great to work with. And it was nice because he took the time to get with David on our package. So he hasn't been able to spend as much time with us the last few months, but um, you know, definitely worth spending some time if you're, especially if you're transitioning. I had this conversation the other day with one of the guys that just signed up. I said, I think Infinity Futures, if you're transitioning from the FX, from the spot market, I think they're a great group because they do have so many different videos and guides and an understanding. So your best value is going to be get signed up for the full package, $14.97. If you're just saying, you know what, I just want the order flow and equity trade program, the great thing about it is, let's say you don't even want the order flow, you just want to have a better understanding about the equity trade program, and then you want to add the $50 uh, a month subscription to Smart Alpha. That's still a really good deal. You can do that for $297. And so I think we've made this so there's a number of options. Unfortunately, we're probably hurting ourselves. We probably should just say, nope, we've got one option. It's the ultimate package. Take it or leave it. But we wanted to try something a little different, give people, and traders, that maybe aren't familiar with Ray, an, an opportunity to come in and test drive, spend a week. Then, if you want, you can do that. Are there any questions? I'm going to stop the recording, but I'm going to definitely answer questions. So before I sign off of here, the bonuses will finish tomorrow, which would be the March 27th. And then after that, bye-bye bonuses. But we still want you to come in. All right, I'm going to stop the recording. And if you have any questions, make sure you reach out to us, support@compassfx.com. Give us a call. We actually love to speak to our traders so we can help them, find all the right resources and tools and what's going to work best for them, what's going to fit them best at 972-680-8080 for our number.